February 24th, 2022. Russia wakes up to find $300 billion gone. Not stolen, not lost, frozen. With the stroke of a pen, the United States and its allies made Russia's entire emergency fund, money held in the world's safest assets, completely worthless. Every central bank on Earth watched. And they all understood the same thing. If you hold your reserves in someone else's currency, you don't own an asset, you own permission. Permission that can be revoked. Within 6 months, China had dumped over $100 billion in US Treasuries. Not panic selling, surgical exit, and they haven't stopped. Since that moment, the second largest economy on the planet has been systematically dismantling its dollar exposure, building an alternative financial system in plain sight, while the West argues about inflation and interest rates. $8 trillion in global reserves are quietly shifting. Commodity contracts are being rewritten. Currency swap lines are multiplying. Trade settlement is happening in Yuan, not dollars. This isn't speculation, this is already happening. And here's the terrifying part. When the British pound lost reserve currency status, it took 20 years. The transition was slow, orderly, almost polite. Britain still looked powerful, markets still looked stable, credit still flowed. Until one day, it didn't. This is what finance historians call a rolling top, the most dangerous kind of market shift, because you don't see it coming until you're already halfway down. And the danger wasn't in the price, it was underneath it. Welcome to the wealth timeline, where money, power, and history quietly shape the world around us. Because what's happening right now with China and the dollar system isn't new. It's happened twice before in modern history. And both times, the transition took longer than anyone expected and hurt more than anyone prepared for. Picture the global financial system in 2010. China has just become the world's second largest economy. Its factories supply the world. Its central bank holds more US Treasury securities than any other foreign nation, more than Japan, more than the UK, more than all of Europe combined. The arrangement seemed perfectly balanced. American consumers bought Chinese goods. China earned dollars. Those dollars bought US Treasury bonds. Those bonds funded American deficits. The cycle repeated, smooth and seemingly endless. Both sides complained about it publicly. Neither side actually wanted it to end. This was the foundation of what economists called Chimerika, the economic fusion of China and America that powered global growth for 2 decades. At the time, this looked stable. What no one questioned was the structure holding it up. To understand why China accumulated so many dollars, you have to go back to 1997, the Asian financial crisis. Thailand's currency collapsed in July. By November, South Korea's foreign reserves had evaporated. Indonesia's rupiah lost 80% of its value. Across East Asia, nations that had borrowed in dollars and earned in local currency found themselves unable to service debt. The IMF arrived with conditions: austerity, privatization, political humiliation. Beijing watched closely. China's currency, the yuan, had been under speculative attack. But China had capital controls, strict rules preventing money from flowing freely across its borders. Those controls held. The yuan survived. And Chinese policymakers learned a lesson that would shape the next 3 decades. In a dollar-dominated world, the only defense against financial crisis is holding dollars, massive quantities of dollars. So China built the largest foreign exchange reserve in human history. By 2014, it peaked at nearly $4 trillion, roughly 70% held in US Treasury securities and dollar-denominated assets, an insurance policy against ever facing what Thailand and Indonesia had faced. It worked, but only under conditions that would not last. Throughout the 2000s, the system accelerated. China's export machine grew larger, its dollar reserves grew faster, US interest rates stayed low, making Treasury bonds an easy place to park hundreds of billions. The arrangement delivered tangible benefits. For America, cheap goods, low inflation, and a willing buyer for government debt. For China, employment, industrial development, and financial stability. But beneath the surface, unintended consequences were accumulating. First, the sheer size of China's dollar holdings created a trap. With over $1 trillion invested in US assets, any attempt to diversify quickly would crash the value of its own portfolio. China had become the world's largest creditor to the United States, and therefore dependent on American fiscal health. Second, holding dollars meant accepting dollar rules. When the US froze Iranian assets in 2012, then Russian assets in 2014, Beijing understood reserves held in another nation's currency are only safe until they are not. Third, the dollar's dominance gave Washington unilateral power. Sanctions became a foreign policy tool. SWIFT, the messaging system for international bank transfers, could be weaponized. Any major bank that violated US sanctions risked losing access to dollar clearing. China could see the leverage structure clearly. And in 2013, it began building an alternative, not loudly, not provocatively, incrementally. The The Asian Infrastructure Investment Bank launched in 2015, providing yuan-based development financing. The Cross-Border Interbank Payment System, CIPS, went live in 2015, creating an alternative to SWIFT for yuan transactions. Belt and Road Initiative projects began, including yuan-denominated contracts. None of this replaced the dollar. That wasn't the goal. The goal was optionality, because China understood something about late-cycle hegemons. They don't lose power through revolution. They lose it through substitution. One contract at a time, one bilateral swap line at a time, one central bank diversification decision at a time. The stronger the dollar system became, the harder it was to stop building an alternative. The first real stress appeared in 2018, not in prices, in plumbing. The US-China trade war began with tariffs on steel and aluminum, then soybeans, then semiconductors. The rhetoric escalated, but something more important was happening in the background. China's holdings of US Treasury securities peaked in 2013 at $1.32 trillion. By 2019, they had fallen to $1.07 trillion, a reduction of nearly $250 billion. Markets barely reacted. That was the problem. Normally, when a major creditor sells government bonds, yields rise. Borrowing becomes more expensive. Financial conditions tightened. But US Treasury yields stayed low throughout 2018 and 2019. Why? Because other buyers absorbed the supply. Japanese banks, European pension funds. Most importantly, the Federal Reserve itself, which had expanded its balance sheet massively after 2008 and maintained a structural presence in treasury markets. China was testing whether it could reduce dollar exposure without triggering a crisis. The answer, yes. Then came 2020. The pandemic arrived. Supply chains fractured. The Federal Reserve printed more dollars in 3 months than it had in the previous decade. U.S. debt to GDP crossed 100% and kept climbing. And China accelerated its reserve diversification. Gold purchases increased. The People's Bank of China became the world's largest buyer of gold bullion, adding over 1,000 metric tons between 2019 and 2023. Yuan-denominated commodity contracts expanded. In March 2023, China brokered a deal for Saudi Arabia to accept yuan for oil, a symbolic crack in the petrodollar system that had anchored global finance since 1974. Bilateral currency swap agreements grew. By 2024, China had established swap lines with over 40 central banks, allowing trade settlement without touching dollars. Nothing collapsed. And that was the problem, because when systemic transitions happen slowly, they don't trigger the defensive reflexes that sudden crises do. There's no moment of clarity, no wake-up call, just a gradual erosion of assumption. The inflection moment came in February 2022. Russia invaded Ukraine. Within days, the United States and European Union froze over $300 billion in Russian central bank reserves. Money held in dollars and euros, meant to be the ultimate insurance policy, became inaccessible overnight. This was precedented. The US had frozen Iranian and Venezuelan reserves before. But the scale was different. Russia wasn't a small economy, it was the world's 11th largest. Its central bank held reserves comparable to South Korea or Brazil. And if Russian reserves could be frozen, any reserves could be frozen. Beijing drew the obvious conclusion. Within months, China's treasury holdings dropped another $100 billion, but more importantly, the structural shift accelerated. In 2023, China and Brazil agreed to settle trade in yuan and reais, bypassing dollars entirely. The two countries trade over $150 billion annually. In 2023, the Shanghai Petroleum and Natural Gas Exchange began pricing contracts in yuan. Not as much volume as dollar-denominated contracts yet, but growing. In 2024, ASEAN nations announced increased use of local currency settlement for intra-regional trade. The yuan became the second most used currency in that system. These weren't attacks on the dollar, they were adaptations. Because here's what makes this different from previous reserve currency transitions. China isn't trying to replace the dollar with the yuan, not globally. That would require full capital account convertibility, which would mean giving up the capital controls that protected China in 1997. Instead, China is building a parallel system. Regional trade in yuan, commodity contracts in yuan, Belt and Road infrastructure financing in yuan, a yuan that circulates in emerging markets without ever needing to fully integrate into Western financial markets. From this point on, the outcome was no longer optional. The consequences are already visible, if you know where to look. First, the US Treasury market has absorbed the transition so far because of structural demand. Banks need high-quality liquid assets for regulatory requirements. Pension funds need long-duration bonds. The Federal Reserve maintains a large balance sheet. But that demand isn't infinite. If foreign central banks reduce their treasury holdings by another $1 trillion over the next decade, someone has to buy. Either yields rise, making U.S. borrowing more expensive, or the Federal Reserve expands its balance sheet further, which creates different risks. Second, The dollar's share of global reserve holdings has declined from 73% in 2001 to roughly 58% in 2024. Not a collapse, a slow erosion. The beneficiaries aren't obvious. The yuan has grown but remains only about 3% of global reserves. Gold has increased, the euro has held steady. What's really happening is fragmentation, a world where no single currency dominates the way the dollar once did. Third, and most important, the power shift isn't about currency denomination, it's about leverage. When the US froze Russian reserves, it demonstrated absolute power over dollar-based assets. But it also demonstrated to every other central bank that holding dollars means accepting political risk. That changes the calculus. Nations that once held 80% of reserves in dollars might now hold 60%. Not because they want to abandon the dollar system, but because they want optionality. Saudi Arabia still prices oil in dollars, but it now also accepts yuan. Russia still trades with Europe in euros, but it now settles with China in yuan and rubles. The dollar remains the most important currency in the world, but its importance is no longer assumed. It's conditional. And conditionality is the first stage of decline. Here's what matters now. We're living through a transition that won't appear in textbooks for another 20 years. The kind of structural change that's only obvious in retrospect. This is the nature of rolling tops. Prices are the headline. Plumbing is the story. U.S. equity markets reached all-time highs in 2024. Credit spreads stayed tight. Volatility remained subdued. By price, everything looked fine. Underneath, the architecture was changing. When the yield curve uninverted in late 2024, when short-term interest rates fell below long-term rates after 2 years of inversion, markets celebrated. Historically, uninversion has signaled the end of recession risk. But history also shows something else. Uninversion often marks the beginning of the next phase of credit stress, not the end of risk. Because inversion strains financial plumbing, banks lose profitability, credit creation slows. Uninversion releases that pressure, but it doesn't reverse the damage already done. The credit that didn't get extended, the businesses that didn't expand, the leverage that quietly unwound. This is late cycle psychology. When conditions improve from strain to merely uncertain, it feels like relief. But relief isn't the same as resilience. And this is where China's dollar exit matters, not as a prediction of collapse, but as a framework for understanding incentive structures. China isn't exiting the dollar system because it knows something terrible will happen. It's exiting because it can, because it's built enough alternatives that reducing dollar exposure from 70% to 50% of reserves does not trigger a crisis. That optionality changes negotiating power, it changes financial resilience, it changes the implicit hierarchy of global finance. History doesn't repeat events, it repeats incentives. In 1944, Britain knew the pound was overextended, but it couldn't afford to devalue or abandon the sterling area without triggering a confidence crisis. So it delayed. For 2 decades, Britain maintained a reserve currency it could no longer support. The US faces a similar but different challenge. The dollar's reserve status provides an exorbitant privilege, the ability to borrow cheaply, run deficits without immediate consequences, and export inflation. But that privilege depends on willing participants, on central banks that want to hold dollars, on commodity exporters that price in dollars, on banks that settle trade in dollars. If those participants develop alternatives, not replacements, just alternatives, the exorbitant privilege erodes. Slowly, measurably. The US doesn't lose reserve currency status, it loses marginal demand for dollars at the margin, which means higher yields on government debt, which means larger interest payments on federal deficits, which means less fiscal space for future crises. This isn't a prediction, it's an observation of incentives already in motion. Here are 2 key takeaways you really don't want to miss. First, about systems. Dominance is never permanent, but it's rarely replaced quickly. The transitions that matter most happen over decades, beneath the surface, in the plumbing that markets ignore until it's too late to adjust easily. Second, about behavior. Late cycle markets reward complacency until they don't. The challenge isn't predicting when the transition accelerates, it's positioning before acceleration becomes obvious. That means understanding what you're exposed to, not just in price terms, but in structural terms. If you hold assets denominated in dollars, you're making an implicit bet on continued dollar demand. That's not a bad bet, it's just a bet worth acknowledging. If you assume Treasury yields will stay low because they've been low, you're extrapolating from a period when foreign central banks absorb supply. That assumption may hold, but it's not guaranteed. If you think reserve currency transitions are something that happened in the past, 1920s Britain, 1970s America, you're missing what's happening right now, not as spectacle, as structure. The story isn't over. We don't know whether China's exit accelerates or plateaus. We don't know whether the dollar's share of global reserves stabilizes at 55% or falls to 40%. We don't know whether the next financial crisis exposes dollar dependence or reinforces dollar dominance. But we know the incentives, and incentives eventually become outcomes. If this helped you see the system more clearly, subscribe to the Wealth Timeline, because the next story won't predict the future, it will help you recognize it